Hi, I am Dewan and welcome back to Velocity Banking Together. In this video, we're going to break down one of the core strategies that makes Velocity Banking so powerful. It's called chunking. This one move can help you destroy debt faster, save on interest, and keep your budget nearly the same. Let's get into it. So, chunking explained and how to use Velocity Banking to pay off that debt fast. What is chunking? A chunk is a lump sum payment towards your loan principal, straight onto the principal. The money comes from a line of credit, like a credit card in this example. You repay the line of credit using your monthly cash flow. Repeat the process to accelerate the debt payoff. Why chunking works? It allows you to attack your loan principal right away, not with a little hammer, with a sledgehammer, reducing the total interest you pay, pays off your debt faster without increasing your income. You don't have to get a second job. You don't have to work overtime. We're going to just take your normal money and use that to pay off the debt. Keeps your budget nearly the same, essentially the same. You keep liquidity through the entire process, the most important part of all of this. The chunking rules. You must be cash flow positive. Once again, I repeat, you must be cash flow positive for this strategy. There is a velocity banking strategy if you are negative cash flow, but not in this example. When you're doing chunking, you only want to chunk up to 12 times your monthly cash flow. You don't want to tie up too much money in future cash flow, so don't extend past 12 times your monthly cash flow. Don't chunk more than 66% of your line. So for example, if you have a $10,000 line, you don't want to chunk over $6,600. So we don't want to over leverage ourselves and get too much of our future cash flow tied up. These rules help you to move fast without over leveraging. Why liquidity matters. Traditional loans lower your cash flow. That locks up that money in that monthly payment. Banks love it. That's why they're always talking about loans. For example, if we had a $800 cash flow and we got offered a loan at $446 a month, that would take us down to $353 of cash flow. Over half of our money is tied up with the bank, paying that monthly payment, very little cash flow if an emergency comes up. And so chunking gives you options and open to when life happens. Life is going to happen. You're going to blow a tire. You're going to have emergencies, especially if you got kids like us. Something's going to come up, but you want to be liquid the entire time and have that money available to you. Velocity banking lets you borrow back the funds. It's called revolving. We can put money into that line of credit, but we can get it right back out if we need to. And our borrowing cost is going to be low because we're going to drive it back down with our income. You stay in control of your money. Remember that with velocity banking, you can run the numbers, you can do the math, you can make an informed decision, and you are in control. And so let's go over scenario. Scenario A, we're going to go. This is a perfect example. This happened to me and my wife. We had an air conditioning system that went out in our old home. Guy comes out, looks at it. He says, "Hey, you need to buy a new system, $5,000. We was not prepared. We did not have an emergency fund. We were not prepared. We had low cash flow. And so let's say we were making $6,000 a month. $5,200 was going to our expenses. So we had $800 of cash flow. We go to that bank. We say, "Hey, we got a $5,000 emergency. We need a loan." And the bank's like, "Sure, we'll give you a loan, $5,000, 13%, 1 year. We want that cash flow for 1 year at a $446.59 per month payment." And you're thinking, "Hey, yeah, okay, we have $800 cash flow. We can afford that." But the bank is laughing. They are making good money on you. The total interest that you'll pay over the life of loan over that year is $359.04. But most of all important, it eats up your cash flow. Your cash flow goes down to $353. And so you're locked in for an entire year. You don't want to go that way. Please trust me. So let's go over scenario B, velocity banking. So let's say you had the same $5,000 emergency and you need to get $5,000 quick. You know what? We're going to use an existing line of credit that we have. Let's say you just had a credit card. The interest rate is crazy high, 20%, But like I said, I have a credit card that is much lower than that. We'll talk about that in another video. But let's just say this is an existing credit card that you had and you want to use Velocity Banking. And so we're going to put $5,000 on our credit card at 20%. And we are going to look at our budget, run our numbers. We know our cash flow, we know our expenses, we know our income. And so we're going to put $2,000 every week. We get paid every week. We can put $2,000 on the line. We have money that we have to set aside in our checking account. We're not going to include that in Velocity Banking. Let's say you have to pay rent or something like that that has to go through a checking account. Set that money aside, but everything else on the line. And you know what? In this scenario, we're going to use our credit card at the same time. We're going to put $800 a week, $1,600 bi-weekly on that credit card. And so we're going to be driving it down with our income. We're going to be using it $800 a week. And as you can see, the interest is charged weekly in this case. And so for the first week, $14.62. But as you can see, that interest maybe go up a little bit, but it's going to get back down. Go up a little bit, go back down. And so over the entire time of 21 weeks, we only paid a total of $193.48. But most importantly, like I said, you're liquid the entire time. Look at the ending balance column. We have moments where our available balance was available to us if we needed it. If we had another emergency, we had access to that money. We're driving that principal down just in case if we need it, but the entire time our cash flow stayed at $800 a month. And so let's compare the two. Traditional bank loan, the time was 12 months, locked up for 12 months. Interest that we paid was $359.04. Our cash flow went down over half, $353. You're locked in. Please, and trust me, the bank is laughing. They have your money. They're going to take that money, reinvest it, and your money is locked up. You can't miss a payment. Your money is locked up. Velocity Banking, it took us way shorter, 5.25 months, and we only paid $193.48. A lot less interest. But like I said, the most important part is we had our entire cash flow working for us, driving that principal down, $800 on that principal, and we stayed flexible the entire time. We were still available for any emergencies that might come up. You are a winner doing Velocity Banking strategy, and we just using a scenario where you just had an emergency with an existing credit card. We can actually do better. So what's next? How to pick which debt that you're going to chunk first. We're going to go over a very simple formula, very easy, a strategy to decide which debts we're going to use. It's called the cash flow index. So we'll go over the CFI strategy. Which debt is hurting you the most in your budget? We want to pick that debt and attack that one with our income. And so no more guesswork. No more guesswork of which one should I do. Debt snowball, debt avalanche. No, I want you to do the cash flow index. No more guessing. We follow the numbers. And so I want to thank you for listening to our video. Thank you for visiting our channel. Please subscribe to Velocity Banking Together. We got a lot more videos, a lot more strategies. We want to deep dive into this Velocity Banking philosophy. And I'm so glad that you watched to the end. Thank you. Have a great day. I appreciate it.